At this, Patrick Horan, principal at Agilith Capital, and Carl de Souza with DBRS Morningstar joins me now. I'd like to start with you, Patrick, if I could. So many times I hear people come on the channel and say, well, we like the Canadian banks for their U.S. exposure or their international exposure, and that did not really work out so far this year.
No, it hasn't. I think you nailed it, too. The U.S. Does have a bit of a banking issue right now. They're probably the most highly sensitive to an inverted yield curve from a deposit base. Their deposit systems are so competitive from a brokerage and an alternative side that an upside down yield curve is very problematic. So they're very much more sensitive to the NIM ratio, and we're seeing that play out in all the Canadian banks. So your comments were absolutely spot on.
And yet, you know, even as we see this playing out, when you look at valuations this low, it can be very tempting for investors. Are you one of those tempted investors?
I am actually. I am. We have a toehold right now in CIBC. Which we quite like from a valuation standpoint and the simplicity standpoint, in that they really don't have much in the way of U.S. exposure. So we know exactly what we're going to get. And it's a very simple business model to follow, whereas the other ones have been a bit messier, kind of death by 1,000 cuts, kind of all over there. But our sense is that the loan loss provisions are coming to an end in terms of surprises, and that is usually a really good time to buy banks. A lot of our banks really haven't performed or haven't really outperformed the TSC broader index over the past 5 years, and we think that's a lot of that is already compressed in the multiples. And so we starting to smell, because our base case is that we're not going into a recession. Everything's just fine, and we think there's going to be a reversal of those loan loss provisions, and with multiple expansion, we're going to see some outperformance by the Canadian banks.
I want to bring Carl in on that note, Carl, because you are the credit guy. You watch that side of the banks. You have seen provisions go up. You've also seen gross impaired loans tick up from previous quarters and from a year ago levels. But is that just kind of a normalization process, or is that kind of building and reserving for storm clouds ahead?
At this point in time, we see it as a credit normalization. During the pandemic, the provisions for credit losses and other credit metrics were at unsustainably low levels, and we've been expecting that to increase. And there's been a lag, to be honest, in seeing that happen. Very early signs happened late last fiscal for large banks, and it's continued. And we've seen that through the first 3 quarters of fiscal 2023. We do expect those provisions to continue increasing. And what you saw in this quarter, the Q3 quarter, was that the provisions on impaired loans drove the total provisions higher versus the provisions on performing loans.
We heard Patrick talk about, that if things come out better from the economic picture, that can just drop back down to the bottom line. But one thing that might, put a little bit of fly in the ointment here is the regulatory picture and the requirement to hold more capital. How are you thinking about that?
Yeah, that's a really good question. There's lots of things going on in the regulatory environment. And what you're seeing this quarter as well is the large banks continue to build up their capital levels through internal capital generation as well as DRIP programs. And all the banks thus far, the 4 that have reported increases in their key CET1 ratio. What I expect to see is that the banks continue fortifying their CET1 ratios with things that are coming down the pipeline. And some of those include the OSFI, the Canadian Federal Banking Regulator, has increased the minimum CET1 threshold from 11% to 11.5%. That takes effect November 1st. OSFI could further also increase that domestic stability buffer, which is one of the tiers in the CET1, and they review that in December. So there could even be another increase in the minimum threshold for CET1. Additionally to that, there will also be higher capital impacts from upcoming Basel III reform implementations and U.S. regulatory requirements following the U.S. regional banking turmoil and the changes that are going to result from that.
Patrick, with that regulatory backdrop, can those bank stocks still outperform?
Yeah, I think they can. I think what we're relying on, and I think that's a really good analysis, far more detailed than what we would do here in terms of regulatory capital. But we look at it as a bit of a bit of a cyclical chase down and a chase up. And all we need to see, I mean, there's some serious compression that's already happened in the multiples. We think they're down probably about 20% from what a normalized valuation would be. And when we look out, we just don't see the scary scenario playing out in the economy. I know there's a transition to a much higher interest rate regime. But we don't see, and we know there's going to be, like, the past 10 years is not representative in terms of loan losses of what probably the next 5 to 10 years are going to be. But we think it's manageable. And we think that multiple has to come up, or probably should come up, especially given the dividend yields that these banks carry.
Carl, I'd love for you to pick up on that point and especially talk about the recent anxiety that is out there about the number of mortgages that are being carried that now have amortizations, over 30 years at these banks, that they're only going to be able to, I guess, keep on their books around, 2025, 2026, when all of these people are going to renew at higher rates. And then if they do that, maybe they can't afford it. And that's when we see an uptick in defaults. It could ripple through in terms of impacts to the housing market. So you can kind of follow this bouncing ball of thought. A, how do you see that scenario playing out? And B, are the banks adequately provisioned for that?
If you look historically with the mortgage portfolios, they have performed well. And while history is not necessarily a predictor of future performance, when you look at the current credit quality of the big six's, what we call RESL, real estate secured lending portfolios, they're very strong from both a credit bureau or a FICO score perspective, as well as a loan to value perspective. So the loan to values provide a lot of what we would say is cushion for decreases in prices, and because they're carrying a lot of equity. And so when you look at that, they're entering this period with a very strong book or books amongst the banks. And what I would say is when you look at the big six, they're not all the same. They often get mistaken for that. There's different features of what you referred to as variable rate mortgages and trigger points being hit with the rapid increase in interest rates. So there's variable rate fixed payment mortgages, and there's variable rate adjustable mortgages. So what's of concern, and OSFI has expressed this concern, is with those variable rate fixed rate payments, because essentially what you're maybe doing is kicking the can down the road or a problem down the road instead of addressing it right now. And 2 of the big 6 have variable adjustable rate payments. What happens is they're dealing with those higher payment requirements right now with their clients. And what we're seeing through the reporting is that there is a little bit of an uptick in delinquencies in that, but the performance is still strong, which is evidencing that even on those variable adjustable rate payments, which require borrowers to deal with that right now, not down the road, not at maturity in 25, 26, that's right now, that their performance, for the most part, they're still able to handle those higher payments. And they have some elevated savings still through the pandemic. And, they're obviously making some discretionary spending choices there. So that's a good indicator of how things might play out. The other factor is, yes, in 2025 and 26, a lot of the mortgages come up. It will also depend on where interest rates are at that point in time. Right. And we don't know where they're going to move, right? So 2025, 26, people, Patrick mentioned, don't see a material economic scenario here or a downturn or a recession. So if it's a softer landing, then we'll see how long interest rates stay. The higher rates for longer has been what's been occurring, but I think economists are predicting that interest rates can come down. And if they start to come down, when those mortgages mature in 25, 26, it'll make that burden a little less so. But nonetheless, there will be what we see as some additional pain when the bulk of those mortgages come up.